Hello learners, welcome to our session today. I am your instructor CPA Ringo Frederick. It is a beautiful day that again we are meeting for this session, and our class today, our focus will be on management accounting. Management accounting, of course, the concept is marginal and absorption costing. I know these are not new to us. We've handled several concepts in relation to marginal and absorption costing. But the special case with our class today is that we will be handling a question which was tested in the last sitting paper. That is, of course, this concept was both in management accounting intermediate level and ATD, management accounting foundation, or rather fundamentals of management accounting, right? So the whole concept of today is in regard to marginal and absorption costing. So we're going to start with the question which was tested in CPA. We're going to start with a question which was tested in CPA question number 4. CPA question number 4. CPA question number 4. Of course, if you're interested in the paper, you can always reach us out, or you can, I'm going to attach a link just below this video whereby you can download this question of ours. So let me share this question. So I've said, if you're interested in the question, you can always request via our WhatsApp so that it can be shared to you. Or better still, I'm also going to try and upload it just below this video. I'm going to attach a certain link. So looking at that question of ours, my good students, these are what we are told. These are what we were told. We are told in this case that discuss 4 limitations that a firm might encounter when operating a marginal costing system. You see question 4A. So you need to discuss basically limitations that a firm might encounter when operating a marginal costing system. So there are several basically limitations, of course, that you can always tend to have. So number one limitation of marginal costing is, of course, difficulty in allocating the fixed cost. That is always a very big issue. Number one, we are seeing difficulty in allocating fixed costs. I'm going to explain this when you're talking about basically limitation of marginal costing. So believing that you have the question, so we are saying that here number one limitation, you're talking about difficulty in allocating the fixed cost. How is this limitation, my good student? My good students, you'll find that a marginal costing system only considers variable cost and does not allocate fixed cost to the cost of production. As a result, it becomes challenging basically to assign. It becomes very challenging to assign a fair share, if we might say, a fair share of fixed cost to each unit of production, which can result in inaccurate product costing. So as a result of that, you'll find that it might be a challenge for us basically to maybe aspect of allocate or to share this cost into our product, which at times it might lead us not to come up with the exact product cost. So that is one limitation where we are talking of allocating, or rather difficulty in allocating the fixed cost. And you realize that the examiner there had given us 8 marks. So it is upon us to give a point and do an explanation of the same. Number 2 limitation, my good students, we normally tend to talk about a limitation of marginal costing is that it normally ignores the long-term effects, ignoring the long-term effects effects. The long-term effects of 4, this is what I want us to understand. You'll find that this is a limitation, and the reason why you are saying it is a limitation is, number one, you'll find that marginal costing only focuses on short-term costs and ignores the long-term effects of business decisions. Excuse. For example, a company may decide to reduce production cost by cutting down on quality control or research and development expenses. While this may lead to immediate cost savings, it could harm the business long-term viability by damaging its reputation and eroding its competitive advantage, because the focus actually is on the current. Remember, we said that marginal costing is a direct costing method where we normally focuses on variable cost in only, and variable cost, basically these are costs that will normally affect us periodically on a certain period, whereby it ignores, in this case whenever we're talking of production cost, it ignores the long-term effect. It ignores the long-term effect. That is also another limitation. The other limitation that we can talk about, my good student, here is number 3 limitation. That is a limited use in decision making. Limited use in decision making. Limited use in decision making. How or why are we saying that it has a limited use in decision making? It has a limited use in decision making, my good student. The reason is you'll find that marginal costing is primarily used for cost control purposes, right? It may not be suitable for all decision making scenarios. For instance, if a company is deciding whether to invest in a new project or expand its operations, marginal costing alone may not provide sufficient information to make an informed decision. So you'll find that the whole idea of marginal costing, many a times, it is always used for cost control and not decision making, because the whole idea primarily it is focused on the short term. So you'll find that many a times if you're talking for the long term decision making, marginal costing at times it won't fit very well, because it is purely designed for cost control. It is designed for cost control. So that is also another disadvantage or limitation. Talk about limitation number 4, my good students, of marginal costing. Of course, you can talk about overemphasis on volume. Overemphasis on volume. Overemphasis on volume. Overemphasis on volume. And how is this limitation? This is a limitation because you will find that when you are talking over marginal costing, it assumes that the company's revenue is proportional to its output volume. However, this may not always be the case, as pricing strategies in market demand can have a significant impact on the company's revenue. So overemphasizing volume can lead to basically decisions that prioritize production over profitability, which could ultimately harm the company's bottom line. So in this event, you'll find that the focus majorly in relation to marginal costing is that we normally tend to look so much on the production, on the volume, rather than considering other effects which normally affects what? Our product or our profitability. So as a result, you'll find that we can take that as what? As a disadvantage or a limitation of marginal costing. Probably next time they might ask you maybe limitation of absorption costing, or maybe in this case they could have used a term limitation of direct costing method, which is the same as marginal costing method. So these are some of the things that I know they are in our fingertips because Mwalimu had shared with us some times back. And remember, we have so many points. We have so many points in relation to this. And by the way, our classes are on. For those who wish to join us for our pre-recorded version for live virtual sessions, our classes are on. If you are preparing for August exams, it is advisable that you join these classes as soon as possible, as soon as yesterday, as they normally tend to say, right? So make sure that you've contacted us and we'll guide you on how to join these classes of ours. So after you're done with part A, let us proceed to part B and see what the examiner wanted us to do. So on part B of the question, which Mwalimu has shared with us there, I'm having this company, right? If you've taken a screenshot, well and good. If you've downloaded using the link, that is good. Or if you've also requested us on WhatsApp, that is also very okay. So these are what we are requested to do in that question of ours. This is what you are told. These are what you're told. I'm having this company, of course, by the name Great Limited. Great Limited, manufactures and sells a single product branded gel. The cost data for the product cost is as follows. I'm having the variable cost which I'm given at that point. We're having direct materials, direct labor, variable production overheads, fixed production overheads, variable selling overheads. Then we also told fixed cost per month is I'm having production overheads and I'm having selling overhead. Then additional info, a good examiner is telling us in note 1 that the product is sold for 400 per unit. Great Limited budgeted to produce and sell 30,000 units per month. The actual production and sales units for the months of January 2023 and February 2023 are as follows. Then we are told that note 4, there was no opening inventory work in progress as at the beginning of the period, so making our work much easier. Required, you're supposed to prepare the marginal costing technique and prepare profit or loss statements based on our marginal costing and absorption costing technique. Look at the marks that the examiner is giving us. This examiner of ours is giving us that is actually 12 good marks. Adding with the 8 above, that is a full question of 20 marks, surely. This examiner wanted us to pass. That is the only thing that he wanted us to do. This examiner basically wanted us to pass these exams, and not only passing, but passing with flying colors, right? So, how are we going to go about it? At this point, my good student, it is very essential for you to remember what Mwalimu had shared with us earlier on. Mwalimu earlier on had shared with us, and he mentioned one very important concept, that anytime you are dealing with marginal costing, there's one thing that will always you should always tend to remember. That is, it will always be upon us, first of all, to prepare what? Our product cost statement. This will act as a guide. This will guide us all through any time I'll be handling or any time we will be preparing our statements. So preparing our or looking at our product cost statement. Looking at our product cost statement. Where should we work it out? I can prepare it somewhere here, just beside at this point of ours. I hope it will be very visible. So what I'm going to do, let me squeeze this question of ours on this side so that we can use the other side very well. Then of course Mwalimu is going to literally have it there. So I want us to prepare basically our product cost statement, okay? So these are product cost statement that Mwalimu is preparing. So I'm having our cost statement. Cost statement. I'm squeezing it here. Cost statement. Our cost statement, we start with marginal. This is the first thing that you should always tend to do. And this is what I've always been telling you guys. Like, start by preparing your product cost statement. In this case, if you can check our product cost statement, I want us to start with marginal. For marginal, our focus majorly will be on aspect to do with variable costs only. Where in this case, I'm having production, direct material, I'm having basically direct labor, I'm having variable production overheads. That is selling, so that selling won't affect us at this point. I'm having 60, I'm having 120, and I'm having aspect to do with what? 40. This should give us how much? That is 100, that is 220. So basically, I'm having 220 for marginal costing. I'm going to show you how we'll be using that. What about for absorption costing? Absorption, that one will also be very easy, my good students. And why is Mwalimu saying this one is going to be very easy? Because absorption costing, I'm going to consider our direct materials. I'm going to have our direct labor, variable production overheads, fixed production overheads. So literally, I'm copying and pasting 60 on 20. I'm having 40, And fixed production, always you can clearly see I was given what? I was given 80. So literally I'm having 80. So total, this should give us, that is 300, right? See, because it is 220 plus the 80 that we didn't have. So that is the first procedure. And once you have this already, it is as if you summarized almost everything that you want, everything that will be required to have. So in that case, we prepare our statements. I'm having marginal costing, marginal, right? Using marginal costing. We have January and we have Feb. I'm going to prepare it horizontally. Yeah, I'm having here, this another one is basically absorption, right? Absorption. I'm having January. I'm having February here. I want us to prepare them all at once, so that you see how easy this concept is always, how easy this concept is. This concept is always very easy. So these are what we are having. Yeah. These are what you are having. So basically I can squeeze this question somewhere whereby you can be looking at our details. Believing that is okay. Yeah. Believing that that one is very, very okay. So let us start analyzing that. Let us start analyzing that. Of course, you're going to start with our cells. Right? You're going to start with our cells. What was our cells in this case, my good students? Our cells, what are we told in relation to our cells? Look at note number 3. All of us, let us go to note number 3. If you check note number 3, we are told that cells were how many units? 26,000, right? So literally, I'm going to have 26,000 by our selling price, which was in note number 1, 400. So 26,000 by 400. I'm just going to squeeze it somewhere here. 26,000 by 400. That is for January. What about Feb? Feb, our sales, we had our sales to be 34,000. So for Feb, I'm having like 34,000 here by 400. Yeah? Feb. Let our figures be in thousands. So the first one I'm having 26,000 by 400, which will literally give us 10,400. 10,400. This other one will give us 34,000 by 400. This one will give us 13,600. Our figures are in thousands. 13.6. So, with less, actually, in this case, you can do it all across, actually, because cells will not change. So, the same cells will affect what? I'm trying to do them concurrently so that you can also save on time. So, in this case, I'm having here cells for absorption. It won't change, it will just be the same. 10.4. And basically, how much? 13.6, right? So we have a space here which you can use. So I'm having January. And you're having January. And you're having Feb here. So this is our sales basically is 10.4 and 13.6. Because they're just the same, right? Remember our figures here, my good students, are in thousands. Our figures are in thousands. So once we have that case, we proceed to our production cost. That is in relation to what? Marginal cost of sales marginal cost of sales. Marginal cost of sales. This other one, I'm having what? Cost of sales. I'm working them concurrently so that it should be very easy for us to basically understand each and every item. We start with our opening inventory. Did you have any opening inventory in the month of January? We are told that we didn't have any. What about production cost? I'm going to have here our production cost. Production cost. Production cost. And what is our production cost? That is where we are going to take this item of ours. You see the items that we had computed in terms of our product cost, right? So I'm going to take this item of ours, which was 220. I'm going to take 220 here. We multiply by our production. What was our production during the period? What was our production during the period? Clearly, we can agree that our production during the period, according to our question there, if you can check, that is, of course, note number 3. Note 3, January, what was our production? I'm having 30,000. So 220 by 30,000. 220 by 30,000. So I'm going to have 220 by 30,000, which will give us 6.6. Believing that we are on the same page. That's the beauty part with you understanding the concept. Go to the next bit, closing inventory. What is our closing inventory? We go back to our product cost statement. That's why it is very important for us to prepare this, which I'm having 220. I want a good student to tell Mwalimu what will be our closing inventory in this case. Our closing inventory, we are going to compare this, right? How many units did we produce? We produced 30,000. How many units did we sell? We sold 26,000. So we can agree that I'm having what? 4,000 units which were still in stock by the time we are clearing January. And that will be our closing inventory here, 4,000. So that as at the end of the day, what will we be having? I'll be having 220, very good, by 4 to give us how much? 880. And because it is our closing inventory, therefore we need to deduct. So that we can agree and say here that our gross contribution, I should be having a figure of how much? Actually, that is not our gross contribution. We start first of all by determining our marginal cost of sales. Let me term this as marginal cost of sales. Marginal cost of sales, 6.6 minus 880. I'm having 57.20. So that this will give us our marginal cost of sales. So that our gross contribution here, I should be having a figure of how much, my good students. I'm going to have my 10.4. I take 10.4. I less 57.20, which will give Mwalimu 4,680,000 being our gross contribution. That is for the month of January. Proceed to the month of Feb. Month of Feb, my closing inventory in the month of January, therefore, will be our opening inventory in the month of Feb, 880. What about my production cost? My production cost will not change because it was still 30,000 in the month of Feb. Assuming you had a different figure in the month of Feb in terms of production, then our production will have changed. But this time round, it's just the same. So I'm going to take 6.6. What about closing inventory? Do we have any closing inventory, my good students? I want us to understand this concept clearly. Do you have our closing inventory? Let us see. My opening inventory is 4,000. We produced how many units? My production was 30,000. So in total, we had 34,000. How many units did we sold during the period? Our sales during the period, we had 34,000. So what is our closing inventory? Our closing inventory is literally nil. I don't have anything in relation to our closing inventory. So therefore, closing inventory, I'm going to have a dash there indicating that it is nil. So once I have that, therefore my marginal cost of sales will be 6.6 plus 880 to give us 7480. So that once I have this, I can literally come and determine our gross contribution to be 13.6 minus answer. I'm having 6,120,000. That is our gross contribution. Kindly confirm with Mwalimu if we are getting the same answers. The question is, did you do that? Did you do that? Did you do that? Worry not, worry not, worry not. All will be well. So after that case, when I'm dealing with marginal costing, I should remember that I'm supposed to consider what we normally tend to refer to as our variable costs. Other variable costs that you're having. In this case, what variable cost did we have? What variable cost did you have? The variable costs that we had in this case, I can clearly see I was given selling and distribution. Look at the statement where I was told variable selling overhead is 30. So I'm having selling overhead. Variable selling OHD. That was 30 per unit, and therefore what will we be having? In January, we sold 26,000 units. By 30, that should give us 780. In Feb, we sold how many units? 34,000. So 34 by 30, that should give us 1020. Believing that you're seeing where the figures are coming from. Literally, on this case, we are taking the 30 variable cost by the number of units that we sold, which was 34. On this other end, we've taken 30 by 26. That is what you are taking. That is what you are taking. Literally, that is what you are taking. So that we didn't have any other variable cost. So this should give us our net contribution. Net contribution. Net contribution. Therefore, I should be having 4680 minus 780, which will give me 3.9. Whereas the other one, I should be having 6120 minus 1020, which should give us 5.1. Did you have any other item, my good students? Yes, we had fixed costs. We had fixed costs. So we less our fixed costs. We less our fixed costs. So our fixed costs, what did we have as our fixed costs? I'm having fixed production, overheads, fixed production, OHDs. How much were we given in our case? Look at that statement summary where we had fixed cost per month. I'm having number one, fixed production overheads of 2.4. Then I'm having another one, which is fixed selling overhead. So fixed selling OHDs, which is how much? Which is 1.8. So having all this, we can comfortably come and say these were fixed, so they were constant in all the months. We can literally come and agree and say, therefore, that my net profit here will be how much? Talk of our net profit. In this case, we should be talking of net profit of how much? I'm having our net profit to be 3.9 minus 2.4 minus 1.8. I can see I'm having a loss. So net profit or loss. In this case, I'm having a loss of 300,000, which is okay. The other point, I'm having 5.1 minus 2.4 minus 1.8. So this one I'm having a profit of 900. You have all your 6 marks. At that point, you have all your 6 marks. You have all your 6 marks. We are done with marginal costing. We are done with marginal costing. We are done with marginal costing. Let us proceed to absorption costing and see what we have. Let us proceed with absorption costing and see what we have. So cost of sales now, I'll just be copying and pasting. Our opening inventory, my good students, you've agreed, we don't have. Our production cost now, what are we going to do? Because we have our units there, allow me just to hide now this question of ours. Our production cost therefore will be, you see the 300, the one that we had computed here. So I'll just be taking my 300 by our production, which was 30. Right? That is, of course, 300 by 30,000. That should give us literally a figure of how much? 300 by 30,000. That should give us a figure of 9 million. What about our closing inventory here? My closing inventory, what we'll be having, basically, I'm going to have the 300 times closing inventory. We got a figure, how many units? 4,000. So basically, I'm having 300 here by 4, which is going to give us a figure of 1.2. So 1.2, that one will less. To get now our cost of sales, cost of sales will be 9 million minus 1.2 to give me 7.8. So that as at the end of the day, my sales minus cost of sales should give us our gross profit. This is gross profit. Remember the other one you're timing it as what? Gross contribution, right? So gross profit will be 10.4 minus answer to give me 2.6. Believing that we are on the same page. What about our Feb month? Closing inventory in the month of Feb will be our in the month of Jan will be our opening inventory in the month of Feb. Our production cost, that will not change, it will just be 9 million. But suppose we had different figures of our production, that will have changed. We realize that you didn't have any closing inventory in Feb, so that one will be dash. So this should give us a figure of 1.2 plus 9 million to give us 10.2. Having our 10.2 being our, basically our cost of sales. Therefore, my gross profit will be 13.6 minus answer, which will give me 3.4. So that will be your gross profit. Now, in this case, I'm not going to consider, first of all, expenses. We need to identify if we had aspect to do with under slash over absorption of OHDs. Very important to consider if we had either under or over absorption of overheads. And how will we always look at this, my good students? This one will always be very simple. And why is Mwalimu saying that this one is going to be very simple? It's going to be very simple because I'll just be comparing our production cost. I compare my production cost, fixed production cost. I compare marginal and absorption. If, in this case, if at all absorption is more than marginal, therefore I'm having over absorption of overheads. Over absorption of overheads will understate our profit. So therefore, what do we need to do? We need to add it back over absorption. Under is when whatever that we have absorbed is less than what we had budgeted. So therefore, in this case, you'll find that I will have overstated our profit. So to correct it, what will be required for under will be required to deduct it. So let us compare this. Let us compare this. Let us compare this. Let us compare this. In this case, we have number one. We have basically talk of number one, marginal. Marginal fixed production overhead was 2.4. Fixed production overhead was 2.4. Fixed production overheads was 2.4. Under absorption, what did we have? Under absorption, that will be simple. I'm going to take whatever that you're having as our fixed production overheads, which was 80, right? We multiply by the number of units that we produced. This is what we are saying. I'm going to have 80. We multiply 80 by our production, which was 30,000, which will literally give us again 2.4. So here, I don't have either under or absorption, because 2.4 minus 2.4 is literally 0. So therefore, this is dash, this is dash. I won't be having any, so that in that case, once I've already identified that, these are what you're going to do. I'm going to consider this bit to be 2.6 here, and I'm having 3.4 here. So that as at the end of the day, talk about our expenses. Talk about our expenses. How will be our expenses? Our expenses now, this will be easy because I just be taking our selling expenses, right? Which I'm having variable selling OHDs. I'm going to copy and paste. We had it here, which was 780. And for the month of Feb was 1020. I'm going to have fixed selling OHDs, fixed selling OHDs. So I'm going to have what? I'm going to have basically, that is 1.8 and 1.8, 1.8 and 1.8. So literally, this is what? This is our expenses. That is our expenses. That is our expenses. So once we have that case, my good students, what next? Just a moment here. Just a moment, we are clearing this question. Great. So once we have that, therefore my profit will be our net profit here. Net profit here. I should be having what? I should be having 2.6 minus 780 minus 1.8. So therefore I'm having 20. The other one 3.4 minus 1020 minus 1800, that should give us what? 580. So that is what you are expected to do in this question of ours, my good student, for us to earn the 12 marks. For us to earn the 12 marks, that is what you are expected to do. So we can go ahead and actually prepare a reconciliation. Though you are not asked this, but for us, for the basis of knowledge, we can go ahead and prepare what? And prepare the reconciliation statement. So reconciliation statement is easy. Actually, I'm going to do for one item. Then you'll do for me the other item. Okay, let us do for January. Let us do for January and see how reconciliation statement is. So where should I erase? Because I'll only be required to have the net profit. And of course, the aspect of opening inventory should be very vital. Yeah. So in this case, reconciliation, where should I do that reconciliation? Let me erase this because this one we won't use it again. I'll show you guys the easiest way that you can always tend to do your reconciliation statements. Okay. So looking at our reconciliation, This is the easiest way that you can always tend to have it, right? So you start with profit as per marginal. So you start with the profit as per marginal, which will be how much? Profit as per marginal, profit as per marginal, I'm going to squeeze it here. Profit as per marginal, what did we have? These are what we had. A loss of 300. So I'm having loss of 300. Right? After that case, we add overstatement. O will stand for overstatement. Overstatement of opening inventory. Then we add again understatement. Understatement of closing inventory. Okay? Then you less, if we'll be having any, you less understatement. Understatement, of course, of opening inventory. Then overstatement. Overstatement of closing inventory. So this is actually literally, this will give us a format of what? Of our reconciliation. So that whatever that I'll be having there, this should literally give us what? Our profit as per absorption. Profit, this is as per absorption costing. Profit as per absorption costing. Profit as per absorption costing. Okay? So how will you compare? Let us start by comparing this. I need to look at our inventory. We didn't have opening inventory. So therefore, dash, dash. Closing inventory. What did we have? Closing inventory under absorption is 1.2. Closing inventory as per marginal is 880. So our base being marginal, you'll find that I'm having what? Understatement. This inventory in marginal is lower than inventory in absorption. My good students, that will give us what? Under absorption, or rather understatement. If at all we had marginal costing having a higher figure of inventory than absorption, we could be having what? The overstatement. Because now I'm having marginal having a lesser value of inventory compared to absorption, I'm going to have understatement. So what is this understatement? The understatement of closing inventory, therefore, I'm going to have what? I'm going to take my 1.2, very comfortable, I less 880, which will give us here 320. Because I'm having that, that is to say here I'll be having dash. So therefore, what will be our profit as per absorption? That will be negative 300 plus 320. So literally I can see it is what? It is 20. Is this the same figure that you're having under absorption? You can confirm. This is exactly the same figure that you're having here. This is exactly the same figure that we are having there. I want you to do for February and see if you're going to achieve the same profit. Use the same format and clearly advise and tell Mwalimu what will you be having, given the fact that in February we are having what? You're having in opening inventories and no closing inventory. Yeah, for you to earn your 20 marks, that is what you expected to do. That's what you expected to do. So in that point, guys, thank you so much. Let us meet in our next session. And recall, as Mwalimu was mentioned, our classes are on. Our classes are on. Our classes are on. Yeah, to that point, guys, see you in our classes, both pre-recorded version or live virtual sessions. Thank you so much. See you then.